Quick concept check for swing trading. A swing trader is looking to take advantage of pivot to pivot action. So an example here over on the far right hand side of this chart of Microsoft here, maybe a trader caught that breakout reversal off of this pivot forming right here, and they maybe had a profit target out near resistance, or they trailed stop losses, and they'd be looking to take a profit somewhere out here, trying to capture the bulk of that swing. Now, the average swing in the market is around 10 days. It varies, of course, from stock to stock. But again, here's a couple of examples of swing trades. Maybe you catch the retracement right there or the breakout right there, and you're using a target or a trailing stop loss. Perhaps take a profit out here somewhere near 120 or 119 or so as the stock price reversed, forming a resistance pivot there. So again, a swing trader is going from pivot to pivot. And again, average number of days between pivots for the market's about 10 days. It varies from stock to stock. And again, there's a high percent yield for a very short period of time. A swing trade, by definition, is entered and exited on different days, so different than a day trader. And typically, the goal is to trade in and out within the context of a swing, which on average is less than 2 weeks.